Hi, this is Scott Hamilton from InKnowVision. Thanks for watching this webcast. This is one of a series of short videos on captive insurance companies, and you can view more of these videos by going to YouTube and searching for InKnowVision Captives. You can also find more information on our website, innovision.com. These videos are educational and are not designed to be tax advice. Please read the disclaimer on the last page for more information. If you have any questions or if you would like to open a conversation about what might be next in terms of getting a captive going for your company, feel free to contact us. Our phone number and email are listed on this slide and also on the last slide in this short presentation. Today we're going to be talking about distributions from captive insurance. Lots of our clients are interested in captive insurance. They like the idea of being able to shift some of their business risk off their balance sheet and onto the balance sheet of the captive. They also like the wealth accumulation aspects and the asset protection aspects. And there's also, of course, the tax deferral aspect of a captive, which is attractive to many business owners. So whatever the reason that you're attracted to or maybe there are multiple reasons why you're attracted to captive insurance, a lot of our clients are saying, well, this is all great, but let's assume that we are successful in our captive, we don't have a lot of claims, we're able to build up profits and over time, how do we get that money out of the captive insurance company? How do we take advantage of it? And really, there's three things that can happen here. One is, of course, while you're still a captive insurance company, if you've got profits, those profits can be invested. We typically see those profits invested in marketable securities, accounts, public equities, stocks, bonds, this sort of thing. Although it's not totally required that you do that, you could also invest in real estate. You could have other investments in private equity that you like, but generally that's what we're seeing. And so after a period of time, you're going to want to try and get your money out of there. And there's basically a couple different ways that money comes out. So we're going to address three quick questions here. What happens at the end of the captive? When money comes out of the captive, is it subject to tax? And if so, how is it taxed? So there's really an embedded what happens at the end of the captive. There's also another question in there is what happens during the operation of the captive if we want to get the money out. So let's just say, first of all, that during the operation of the captive, so if you have a captive and you're running it for 5 years or 10 years or however long it makes sense for you to have a captive insurance company, if distributions are going to be made from the captive to the shareholders of the captive, to the owners, then those distributions, which can come out, they have to have regulatory approval typically, uh, which means basically that you have to demonstrate to the insurance regulator that making a distribution is not going to hurt the financial stability of the company. Now, if you've got a year or two of good profits, you're going to definitely be able to make a dividend. Are you going to be able to take out all of your profit? I would say probably not. On the other hand, I would say there's a lot of really good reasons why you wouldn't want to take out all your profit. But just know that if you had to, you could get a big amount of your profit out. And when that comes out, it's going to come out as a dividend. Now, you could do dividends every year, just like a lot of companies do dividends every year. You could do that. We have clients who have a certain amount of profit. I'll just pick a number. Let's say they have $800,000 of profit in their captive, and so they might do a dividend of $200,000. The insurance regulator is going to be perfectly fine with that because they've got plenty of reserves to pay claims going forward. The other time when you might want to get money out of your captive is when you want to terminate the captive. So you've decided, this has run its course. It's been good for me. It's been great for the business. We've accomplished our goals. But now it's over. And so at that point, you're going to probably close down your captive and distribute out your profits, however many profits you may have had over the years, to the shareholders. So you've got those two basic options. You're going to have either dividends, which we'll talk about in a minute, are coming out over time, versus capital gain when you make a distribution at the end, sort of a winding up distribution. Okay, so remember that you got a tax deduction going in to your company when you paid the premiums, which is obviously a plus. And the captive, because it's treated as a small insurance company, didn't have to pay tax on the premiums. All this is sounding great. And of course, at some point, as you might imagine, the piper has to be paid. You do have to pay taxes on this money, or at least on the profits of this money. And you do pay tax when the money comes out. And it's a pretty simple thing. If it's coming out sort of on a year by year basis, that's going to be treated as a dividend, which is going to be treated at taxed at dividend rates. And then if you're doing a wind up and you're essentially distributing substantially all the profits of the company, then that's going to be treated as a capital gain. And of course, right now that doesn't make a huge bit of difference because the tax rates are the same. But historically, at least I would say until the late 90s, there's been sort of a different rate for dividends than for capital gains. And depending on what state you're in, there also may be different rates for dividends and capital gains. So it could make a difference in terms of how you take this money out of here. And obviously, as you're looking at taking money from the captive, you want to be thinking about tax rates and see whether or not there's any advantage to doing a dividend distribution as opposed to a winding up capital gains distribution. Now, for most of you who are listening to this, you don't have a captive, so that means you're looking out into the future at this. This is obviously one of the things that we'll do as part of consulting with you on captive insurance, is we'll be helping to plan the ongoing distribution of profits and also the exit from the captive. But the key for today is think about it. If money is coming out annually and relatively slowly, that's going to be taxed as a dividend. Long-term distribution to wind up will be a capital gain. So that's pretty much it on the taxes. And most of our clients are not taking substantial amounts of profits out of their captive because of the wealth building and the asset protection aspects of a captive insurance company. There are a lot of good reasons to leave money in a captive, and of course we'll explore those as we're going through. I just wanted to let you know what some of your options were and how distributions were handled from a captive. So hopefully that gives you a pretty quick and good idea of how you would get money out of a captive insurance company that's been profitable. If you have questions about this or any other aspect of captive insurance, we'd be glad to have a conversation with you. Feel free to give us a call at the number that's on the screen. If you prefer, you can send an email. We'll try to do our best to answer that. And if you're just interested in learning more about other aspects of captives, you can go to YouTube to the link here, or if you just go to YouTube and search on InKnowVision captives, you'll find more of these short videos. You can also get them at our website, InKnowVision.com. So look forward to it. Thanks for spending time. Hope that this has been helpful for you. And again, if there's anything we can do, please feel free to get in touch. Thank you.